The economy you see on the surface feels stable, structured, and predictable. Governments publish growth numbers, central banks promise control, and markets appear to function on logic. But beneath that surface lies a system built on cycles that repeat with striking consistency. In 2008, the global financial system nearly collapsed under the weight of debt most people didn't even know existed. Just over a decade later, global debt exceeded $300 trillion, reaching levels never seen in human history. The question is not whether the system is stable, but whether it has ever truly been. What if the economy you've been taught to trust is not a system designed for stability, but one designed to expand endlessly? What if growth itself is not a sign of health, but a requirement to keep the system from collapsing? These are not abstract ideas. They are patterns embedded in history. Every major economic collapse follows a similar structure. It begins with debt expansion, accelerates through credit growth, and ends in instability when the system can no longer sustain itself. This pattern has repeated across centuries, continents, and currencies. To understand the truth, you have to stop thinking of the economy as a static machine. It behaves more like a cycle, a loop driven by incentives, policy decisions, and human behavior. And like any cycle, it has predictable phases. The first phase is expansion. Governments borrow, banks lend, and consumers spend. Economic growth appears strong, asset prices rise, and confidence spreads across markets. This expansion is not accidental. It is actively encouraged through monetary policy. Central banks lower interest rates, making borrowing cheaper and incentivizing both businesses and individuals to take on more debt. Over time, this creates a feedback loop. Rising asset prices make people feel wealthier, which leads to more borrowing and spending. This, in turn, pushes prices even higher. But beneath this growth lies a hidden vulnerability. Debt is not neutral. It must be repaid. And when debt grows faster than income, the system becomes fragile. The second phase begins quietly. Debt levels reach a point where repayment becomes difficult. Borrowers start to struggle and defaults begin to increase. At first, these defaults are contained. Banks absorb losses, and central banks intervene to stabilize markets. But the underlying issue remains unresolved. There is simply too much debt. This leads to the third phase, instability. Confidence begins to erode, asset prices fall, and liquidity dries up. What once looked like growth is revealed to be leverage. Finally, the system reaches a breaking point. Governments and central banks step in with emergency measures, bailouts, money printing, and policy interventions designed to prevent total collapse. This is not a rare occurrence. It has happened repeatedly throughout history, and each time, the response follows a similar pattern. To see this clearly, we can look at one of the most significant economic collapses in modern history, the Great Depression. In the 1920s, the United States experienced rapid economic growth. Industrial production surged, stock markets soared, and credit became widely available. By 1929, margin debt, money borrowed to invest in stocks, had reached unprecedented levels. Investors were buying assets not with their own money, but with borrowed funds. This created a fragile system. When stock prices began to decline in October 1929, margin calls forced investors to sell, accelerating the collapse. The market crash wiped out billions of dollars in wealth, but the real damage came from what followed. Banks, heavily exposed to loans and investments tied to the stock market, began to fail. Between 1930 and 1933, over 9,000 banks in the United States collapsed. As banks failed, depositors lost their savings. This led to widespread panic, with people rushing to withdraw money from surviving institutions. The result was a contraction in the money supply. Between 1929 and 1933, the U.S. money supply fell by nearly 30%. This contraction deepened the economic downturn. Businesses failed, unemployment soared, and global trade collapsed. By 1933, unemployment in the United States had reached approximately 25%. Entire industries were crippled, and economic activity came to a near standstill. The response to this crisis marked a turning point in economic policy. Governments began to take a more active role in managing the economy. In 1933, the U.S. government abandoned the gold standard domestically, allowing for greater control over the money supply. This decision fundamentally changed the nature of monetary policy. At the same time, new regulations were introduced to stabilize the banking system. The Glass-Steagall Act separated commercial and investment banking, aiming to reduce systemic risk. These measures helped restore confidence, but they did not eliminate the underlying cycle. They simply reset it. The next major phase of the global monetary system began in 1944 with the Bretton Woods Agreement. This established a new framework for international finance. Under Bretton Woods, the US dollar was pegged to gold at $35 per ounce, and other currencies were pegged to the dollar. This created a system of relative stability. For decades, this system supported global economic growth, but it also contained inherent tensions. As global trade expanded, the demand for dollars increased. The United States responded by increasing the supply of dollars, effectively exporting its currency. By the late 1960s, the US was running persistent deficits. Foreign governments began to question whether the United States had enough gold to back its currency. In 1971, President Richard Nixon ended the convertibility of the dollar into gold. This marked the collapse of the Bretton Woods system. From that point forward, the global economy operated on a fiat currency system. Money was no longer tied to a physical asset, but to government policy and trust. This shift allowed for greater flexibility, but also removed a key constraint on money creation. Governments could now expand the money supply without direct limitations. The effects of this change became evident in the 1970s. Inflation in the United States reached double digits, peaking at over 13% in 1979. Central banks responded by raising interest rates aggressively. In 1981, the Federal Reserve increased rates to nearly 20% to combat inflation. This brought inflation under control, but at a cost. The economy entered a severe recession, and unemployment rose sharply. Once again, the cycle reset. Lower inflation allowed for lower interest rates, which in turn enabled a new phase of credit expansion. This pattern continued into the late 20th and early 21st centuries. Each cycle of expansion was supported by increasing levels of debt. By the early 2000s, this debt was concentrated in the housing market. Low interest rates and financial innovation made mortgages widely accessible. Banks began to package these mortgages into complex financial products, spreading risk across the global financial system. This created the illusion of stability, but the underlying problem remained. Many borrowers could not afford to repay their loans. The system was built on assumptions that did not hold. When housing prices began to decline in 2007, the entire structure began to unravel. Defaults increased and the value of mortgage-backed securities collapsed. In September 2008, the investment bank Lehman Brothers filed for bankruptcy. This event triggered a global financial crisis. Credit markets froze, stock markets plunged, and governments were forced to intervene on an unprecedented scale. Trillions of dollars were deployed to stabilize the system. Central banks lowered interest rates to near zero and implemented quantitative easing. This involved purchasing financial assets to inject liquidity into the economy. These measures prevented a complete collapse, but they also set the stage for the next phase of the cycle. Debt levels continued to rise. By 2020, global debt had reached over $250 trillion. In response to the COVID-19 pandemic, governments and central banks expanded this further. Stimulus programs, emergency lending, and monetary expansion pushed global debt beyond $300 trillion. This represented more than 3 times global GDP. At the same time, central banks maintained historically low interest rates. This made it easier to service debt, but also encouraged further borrowing. Asset prices surged, stock markets reached record highs, and real estate values increased significantly in many regions. But this growth was not evenly distributed. Wealth inequality widened, and many households remained financially vulnerable. In 2021 and 2022, inflation began to rise sharply. In the United States, inflation reached over 9% in June 2022, the highest level in 4 decades. Central banks responded by raising interest rates rapidly. This marked a shift from expansion to tightening. As rates increased, the cost of borrowing rose. This put pressure on households, businesses, and governments alike. Highly leveraged sectors began to show signs of stress. Financial markets became more volatile, and concerns about recession grew. This is where the pattern becomes critical. The system depends on continuous growth to sustain debt levels. When growth slows, the system becomes unstable. Governments face difficult choices. They can allow the system to contract, risking recession and unemployment, or they can intervene, increasing debt further. Historically, the second option has been more common. This leads to a cycle of increasing debt and periodic crises. At a global level, this raises deeper questions. The US dollar has served as the world's reserve currency for decades, but this status is not guaranteed. Reserve currencies have changed throughout history. The British pound held this role before the dollar, and it declined after World War II. As debt levels rise and monetary policy becomes more aggressive, confidence in currencies can erode. This creates the potential for systemic shifts. Some countries have begun exploring alternatives. This includes diversifying reserves and increasing the use of other currencies in trade. And while these changes are gradual, they reflect underlying tensions in the global system. The current framework is not static. It is evolving. The implications of these patterns are significant. Economic stability is not a permanent condition, but a temporary phase within a cycle. Debt, which drives growth, also creates vulnerability. The same mechanisms that support expansion can lead to collapse. Understanding this requires a shift in perspective. Instead of viewing crises as isolated events, they should be seen as part of a larger pattern. This pattern is not hidden, but it is often misunderstood. It is shaped by policy decisions, incentives, and structural dynamics. The economy you know is not a fixed system. It is a process, one that evolves, adapts, and occasionally breaks. What comes next will depend on how these dynamics unfold, but history suggests that cycles do not disappear. They repeat. The real question is not whether another crisis will occur, but when. And more importantly, how prepared the system will be when it does. Because the truth is simple, but uncomfortable. Stability is not the default state of the economy. It is the exception. And once you understand that, everything begins to look different.